Okay, let's dive into this. Welcome to today's explainer, where we're going to demystify one of the absolute most powerful visual tools in financial markets, the candlestick chart. Look, if you've ever stared at a price chart, you know it can kind of seem like a totally chaotic jumble of green and red lines just moving at random. But actually, what you're looking at is a literal battleground. Every single mark on that chart is a historical record of a fierce conflict between buyers, the bulls, and sellers, the bears. So today, we're going to learn exactly how to read the casualty reports of those battles, so you can understand who's winning, who's losing, and most importantly, where the market is likely to go next. To keep things simple, here's our roadmap. First, we'll cover the anatomy of a candlestick. Second, bullish patterns. Third, bearish patterns. Fourth, neutral patterns. And finally, we'll wrap up with the golden rules of trading. All right, part one, anatomy of a candlestick, the battlefield. So to understand the wider war of the market, you really have to understand a single battle first. And that's exactly what each candlestick is. It's a specific battle locked in a specific time frame. Technically speaking, a candlestick is just a graphical representation of data showing price movement. But honestly, don't let that dry textbook definition fool you. It takes this chaotic, messy stream of numbers and translates it into a crystal clear, visual language of market psychology. It literally tells a story of fear, greed, and momentum. Now, what's really interesting about this slide is how instantly the colors reveal the victor of that particular session. A green, or bullish candlestick, means the closing price was higher than the opening price. Basically, the buyers won this round. On the flip side, a red, or bearish candlestick means the closing price was lower than the open, telling us the sellers completely dominated. Digging a bit deeper, every standard candlestick has 5 crucial parts: the open, the close, the high, the low, and the body. That thick colored section right in the middle, that's the body, and it represents the main territory fought over between the opening and closing bell. Those thin lines poking out of the top and bottom are called the wicks, or shadows. You can basically think of these as the scouting parties that push deep into enemy territory, only to get beaten back by the end of the session. Moving on to part 2, bullish patterns. Buyers take control. These patterns are all about an epic comeback. They usually form right at the bottom of a downtrend, and they show exactly where the bulls suddenly drew a line in the sand. Take the hammer candlestick pattern, for example. Just look at its shape. It's got a small body at the top and this really long lower wick that's at least twice the size of the body itself. The narrative here is super dramatic. The sellers ruthlessly pushed the price way down during the session. That's your long lower wick. But they just couldn't hold it. The buyers violently rejected those lower prices, surging all the way back to regain control and close near the very top. It's a massive psychological shift that signals a potential reversal. So, how do you actually trade this? Well, the strategy for the hammer requires strict discipline. You definitely don't just jump in immediately. Instead, you wait for the next candle to break above the hammer's high. That is your entry trigger. Then, you place your stop loss safely below the hammer's low. This protects your capital just in case the bears try another ambush. And crucially, you always target the nearest resistance level or aim for a solid 1-to-2 risk-reward ratio. Now, let's see how this builds into slightly more complex formations, like the Morning Star. This isn't just a single candle, it's a full 3-candle turning point. First, you get a large red candle. The sellers are totally in control here. But then the second candle is small, revealing this sudden wave of indecision. The downward momentum just halts. Finally, the third candle is a massive green pillar that closes well above the midpoint of that first red candle. The sellers lost their grip, they hesitated, and then the buyers completely swarmed the field. Which brings us to part 3. Bearish patterns. Sellers strike back. You see, the bulls just can't run forever. Eventually, exhaustion sets in, and the psychology flips in an absolute instant. And this brilliantly illustrates that shift, comparing the bullish engulfing with the bearish engulfing. Focus on the bearish pattern for a second. You have this small green candle representing really weak, dying buying pressure. And then, bam, a massive red candle prints that completely swallows or engulfs the previous candle's body. The bears didn't just win this round, they overwhelmingly crushed the bulls. It's a total psychological reversal. Your strategy for a bearish engulfing is pretty much the exact mirror image of your bullish tactics. You enter your short position when the price drops below the low of that massive red candle, and you tuck your stop loss just above its high. Now here is a vital piece of intelligence directly from the source material. Both of these engulfing patterns are significantly stronger if they happen at key support or resistance levels, and especially if they are backed by high trading volume. Volume is key here. It proves there's a real army behind the move, not just some random small scouting party. Sometimes, though, the market sets a trap, and that perfectly describes the shooting star pattern. Visually, it just looks like an upside-down hammer right at the top of an uptrend. The underlying narrative here is a failed breakout. The buyers got aggressive. They pushed the price up to thrilling new heights, which is represented by that long upper wick. But it was a trap. Selling pressure suddenly overwhelmed them, slamming the price right back down, leaving a small body near the open. It's a very familiar heartbreak for any overeager trader. The bulls tried. They failed dramatically, and a downward reversal is now highly likely. Let's look at part 4, neutral patterns, market indecision. Sometimes the battle ends in a dead tie, a standoff. To really grasp this market indecision, we first need to contrast it with absolute certainty. Think of the Marubozu candlestick. This is a massive, full-bodied candle with absolutely zero wicks. A green Marubozu means buyers dominated from the very first second to the very last. Total, absolute certainty. But on the complete opposite end of that spectrum, we have the doji, where certainty totally vanishes into sheer uncertainty. Notice how the doji almost looks like a cross. Interestingly, the word doji is actually a Japanese term that translates to the same thing. It gets this name because the opening price and the closing price are nearly identical. There's practically no real body here. The market opened, fought violently up and down, and then closed exactly where it started. Buyers and sellers are locked in a perfectly paralyzed state of balance. A close cousin to the doji is the spinning top. You can see it has a very small body, but notably long upper and lower wicks that are at least twice the body size. The story here is one of extremely high volatility, but absolutely zero progress. Both the bulls and the bears fought fiercely, dragging the price wildly up and down, but ultimately, nobody could secure the territory. When you see a doji or a spinning top, the market is basically holding its breath. Proceed with caution. And finally, part 5, the golden rules of trading, rules of engagement. Look, spotting these patterns is super satisfying, but recognizing the shape is only half the battle. Surviving the market long-term requires strict discipline. Across all the data we've analyzed today, 3 major themes for survival constantly repeat. Number 1, a pattern in isolation is weak. These signals are always exponentially stronger when they occur at key support or resistance levels. Number 2, high volume is absolutely crucial. A reversal pattern with low volume is kind of like a threat with no weapons to back it up. And number 3, always stick to your risk management. Target at least a 1-to-2 risk-reward ratio, ensuring your potential gains always outpace your potential losses. So the crucial point is this quote, which appears repeatedly in bold red across the source material. Don't trade without confirmation. Guys, it literally doesn't matter how perfect that hammer or shooting star looks on your screen, the market is full of false signals. You absolutely must wait for the next candle to prove the reversal is real by breaking a high or low of your pattern. Honestly, patience is what separates the survivors from the casualties out there. So, there you have it. We've taken what looks like a chaotic mess of data and turned it into a clear, readable language of market psychology. You now know exactly how to spot when the bulls are rallying, when the bears are setting traps, and when the market is just paralyzed by indecision. The battlefield is laid out right in front of you. The charts are talking. The only question left is, are you ready to listen? Thanks so much for joining me on this explainer, and I'll catch you on the next one.